In part 2, we will look at some of the rates that are used globally in the financial markets, like LIBOR and other alternative rates as well. And we will begin to talk about what it means to benchmark a sale price to LIBOR. We will go through an example which explains clearly how an Islamic bank uses LIBOR to benchmark its profit rate in a sale transaction. Okay, other reference rates like LIBOR. So LIBOR itself is not just, even though it's London, it's not just used for sterling, right? It's also used for US dollar, and I think Japanese yen. There are two other currencies which I can't remember off the top of my head, but that's okay. So other currencies sometimes have their own IBOR. So IBOR is the main thing that's used, the interbank offered rate, and what varies is the letter in front of it. This stands for London. So we have, for example, Euribor, which is the one used for euros. We have in the Emirates is EIBOR, right? The Emirates interbank offered rate. In Pakistan, it's called a KAIBOR for the Karachi interbank offered rate. In Malaysia, it's called KLIBOR, right? Kuala Lumpur interbank offered rate. So you can see each major city has its own variation of LIBOR. Okay, and LIBOR is not the only main benchmark interest rate that markets use. There's also something that's, it has a name like a base rate, but it has slightly different names in countries. So in the UK, we have a base rate, we have a Bank of England base rate. So this is obviously used in England, and this will be for pounds. This applies to the British banking system, the banks that are regulated by the regulator. In the UK, it used to be the Bank of England, but now we have different regulators. So each country will have a different name for its base rate set by the central bank. So for example, in Malaysia, set by Bank Negara, is called the OPR, which is the overnight policy rate. Right, and we can see what a quick definition of the OPR is. So here, I don't propose reading all of this, but the OPR rate set by Bank Negara in Malaysia is an overnight interest rate. Okay, so banks have some link to this because it sets the target rate for day-to-day liquidity operations of the bank, or Bank Negara. So it's the interest rate here at which a depository institution lends immediately available funds to another depository institution. Okay, so it's a benchmark for short-term lending. In this case, it's overnight lending, and of course, it's an interest rate. There's no doubt it's an interest rate. This is part of its definition. It's not a matter for discussion. It's not a matter of opinion. It just is an interest rate. So now let's talk about benchmarking to LIBOR. This is something that occurs a lot in Islamic banking. So let's talk about the process that goes on in order to result in the end situation, which is where prices and transactions are benchmarked to LIBOR. So how does it work? Okay, so we have our regular sale. These are the goods, and we talk about cash being paid. Okay, now where does the benchmarking to LIBOR come into effect? Is to calculate this price. Okay, so one thing about a sale contract is the price must be agreed, right? We've discussed that, and as well as being agreed, it must be explicit. There can be no uncertainty about the price, and it must be a fixed amount, whatever the price is. If it's X, Y, or Z, it doesn't matter, but it must be explicit. There can be no uncertainty in the price. So the way that the parties use LIBOR here, so first of all, party A is often an Islamic bank. Okay. And so party B is often the client, the retail customer of the bank. So the bank will sell certain goods going this way and will ask for a price. And this price will make reference to LIBOR. Okay, to LIBOR or CLIBOR, or whatever reference to the interest rate is, an overnight policy rate, but it'll make a reference to LIBOR. But it must be explicit. It must be agreed, right? So we have to clarify the situation. So LIBOR relates to an interest rate now that's published now. Okay, it's also published in the future, but we don't know what it is in the future. It's published every day often. Normally it's published every day. LIBOR is published at 11 a.m. in the UK every day, so there'll be a certain time of day where the reference rate is published. But it's published now. So there's a rate today and a rate yesterday. So there's an up-to-date market rate. So this is work for spot sale with immediate payment. Okay. Okay, let's go back to our sale. The goods here. So now let's imagine that this is a spot sale with immediate payment, right? The price in pounds is paid immediately. Okay. In this case, there's no need to reference anything because you just agreed the price. And it doesn't matter what you use to calculate the price, right? The price is just agreed and it's paid now. So the only time that you need to make a reference to LIBOR is when the sale price is paid in the future. Okay, so this is an important point to understand. If the sale price is paid now, then LIBOR does not come into it. Okay, and I'll explain why shortly, but it only comes into it when the price is paid in the future. So the bank will sell you goods now and it'll ask for money to be repaid in the future. So it only works when you buy now and pay later. What do we do when we buy from Islamic banks? Okay, so there's commodity murabaha, which is quite involved, and I don't propose to look at that today. We'll look at another version of murabaha, which is goods financing. Okay, and this applies to home finance, car finance, mobile phones, and TV, and so on. So let's look at an example of this. So let's look at something simple first, like a TV. Let's say the Islamic bank offers financing for you to buy a TV. So we have a regular sale transaction. So now the TV is the assets that's being sold, and you'll pay a certain price for it. So this is price you're going to pay in the future. Because you'll notice one thing, that when Islamic banks do this transaction on this side, and you're the customer, they will never ask for you to pay spot. Never, ever. Because it doesn't make sense for them. You have to pay in the future. So now, even though it's in the future, but the price must be agreed. It must be explicit to avoid gharar. Right? You can't have an uncertain price. The price must be agreed. So how do they agree this price? So they say to the client, first of all, they agree the tenor, how long the client has to repay. Is it 1 month, 6 months, 1 year, and so on. They agree that first. And then they agree what the value of the TV is. The TV has got a value. Why? Because when the Islamic bank is selling you something, it doesn't own the TV first, right? It has to buy the TV from a supplier, right? And in theory, it pays cash and the TV is delivered. So we know what this price is for two reasons. Because the bank's just bought it, right? The other reason is that you're the client. You're the one who wants to buy this asset, right? So you're the one you've seen this asset in a shop, right? And you know the price. So it's no surprise to you. So everyone knows how much the TV's cost price is. So what the bank does simply is takes the cost price times the profit rate that it wants times by the tenor or the duration, right? So let's have an example. So let's say the annual profit rate that the bank desires is 5%. And let's say that the duration is 12 months or 1 year. That keeps it simple. So here what the bank would say, that we will sell you a TV. Let's say the cost price is 100. Profit rate is 5% per annum. And the tenor is for 1 year. Right? So the profit that the bank desires, in this case, is £5. Right? So the bank will add this to the cost price, which is 100. So we have 100 plus 5 equals 105. This is the amount of sale price that will be asked to be paid to the bank in the future. And this is calculated with reference to a certain profit rate. Okay. Now the point is that this profit rate, which I said is 5%, this in Islamic banking is always an interest rate that they refer to, whether it's LIBOR or OPR, that they reference this to a they benchmark it to an interest rate. Okay, so there's two key points to be made. First of all, we have the profit rate. Right, this is profit rate on what? On the trading. A bank is, they say it's trading, it's selling assets, to make it sound legitimate, which it's not. It's not doing any of these in a genuine way. And it uses a benchmark to calculate the profit rate. And these are, if the bank is honest and it tells you it's an interest rate, sometimes they will not tell you. And it can be LIBOR. In the UK, the Islamic banks do benchmark to LIBOR, so it depends on your country, right? It could be CLIBOR. In Pakistan, I know Islamic banks benchmark to CIBOR, and so on. And in the Emirates, they benchmark to LIBOR. Or it can be another version, and it could be a, a domestic base rate, for example, which functions in the same way. But these are interest rates. So the first thing is the profit rate calculated by Islamic bank for a deferred sale. It's reference to benchmark, which is an interest rate. And the second thing is that this sale, the price has to be paid in the future, right? Because if you pay it now, you just pay cash now. There's no element of profit rate on calculation. This times this is our profit, right? You just pay it now. But banks don't want that. Banks want you to pay in the future because, why? Because they're giving you a loan. And don't forget, you've gone to the bank to ask for a loan. You've said to the bank, can I pay you in the future? You've asked for a loan if you're the client. So there's two situations where benchmarking occurs. One is where it's benchmarking to a profit rate, which is an interest rate. The second one is where the cash is paid in the future. This is a requirement, especially being paid in the future. In part 3, we will examine the claim by Islamic banks that they do legitimate trading and earn legitimate profit, and that their profit is not interest. We will look at how interest is incorporated into the sale price, and we will examine whether we are introducing any element that may be haram. And we will look at how Islamic banks always do combinations of contracts, not a single contract, and how these combinations can lead something that looks halal that in fact may not be halal.